Hello and welcome. My name is Joe O'Mara. I'm the head of aviation finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Thomas Baker. Thomas is the CEO of Aviation Capital Group. He is joining us for the purpose of our Aviation Leaders Report. I should say we're recording this on the 12th of December. Thomas, thanks as always for joining us for the purposes of the report. Before we get into the meat of the discussion, do you want to tell our watchers a little bit about ACG?
Sure. Thank you, Joe, and thank you for having me again. It's always a pleasure to speak with you. Aviation Capital Group, I hope the audience knows by now. We're a core narrow-body lessor of scale based in Newport Beach, California. Approximately 400-ish aircraft owned, managed, and committed. We are fully owned by Tokyo Century, which is a Japanese financial services company traded on the Tokyo Stock Exchange. And we consider ourselves a lessor of scale in the sense that we are not necessarily the biggest in the industry. We don't feel we need to be in the biggest in the industry, but we are of sufficient size and capability with a flexible capital structure to serve all of our customer needs around the world. We are the lowest levered amongst our peers. We have excess liquidity. We've survived the last 4 or 5 black swan events coming out of COVID, stronger that we've been in a long period of time from a capital structure perspective. So we are a lesser of scale with investment grade ratings that you will see grow into the next upcycle.
And Thomas, given that kind of, as you say, pretty broad reach with that number of aircraft owned and managed, can you talk to us a little bit about how you saw customer performance evolve as the recovery developed over the course of 2022?
Sure. Certainly it's been even. I would say, as I typically like to say, nature abhors straight lines. And so you've seen region by region periods of strength followed by periods of weakness, false dawns, false starts, and then unevenness across the globe. That speaks to anything from the capital structure and positioning and ratings profile of the airline going into COVID, regardless of the region, to the varying degrees of government support that different airlines, different regions, different countries saw through COVID. And then, the discipline and the fundamental blocking and tackling of the various different airlines. So certainly regions have had something to do with it. The United States being one good example, coming out very strong, Mexico, Europe through last summer for a period of time, China, Southeast Asia being the laggards, as it were. But even within those different regions, you've seen pockets of performance, whether outperforming or underperforming. Now we're sort of in this transition period, obviously, where I do think you'll see more moderate growth in the United States, obviously up a very strong base, question marks in Europe around a potential recession. But that could very well be offset by China and Southeast Asia finally coming online. So as is anything, and that's why we diversify and prefer a portfolio approach, we'll see pockets of strength next year, and we'll see pockets of weakness this year, and our ability to play in and out of that will allow us to outperform.
And in terms of kind of focusing on that outperformance and opportunities, is it to that geography aspect you're thinking where, okay, we'll see ASPAC, hopefully China come back online in 23, or is it still a case of, look, it depends on the airline customer, the right size of transaction? Just interested in your thoughts on where you expect to see the opportunities over the coming year.
Mm-hmm. So it's both, Joe. I mean, obviously, again, the industry and we have been waiting a long period of time for China and Asia to come back online. So I think we'll finally start to see that into next year. But more specifically to the customer, ACG and a lot of our leasing peers, we learned a lot about our counterparties, country by country, region by region through COVID. And I think we've all determined who we want to grow with into the next upcycle, and maybe who we want to risk manage down or grow less with or grow away from. And so I think you'll see, and some of that is credit profile on paper, and some of that is behavior, and or partnerships that were formed in very tough times. So yes, I think you'll see us continue to, we grew a lot in Latin America over the last couple of years. So because that's where the growth was over the last 18 months. So I feel like that we're in a pretty good place there. I think there are other parts of the world where we would like to have grown more and we didn't for various different reasons. So we'll focus on those areas. And then hopefully we'll just benefit from China and Southeast Asia, where we do have pretty good exposure already, coming back online. And then within those regions, you'll see us continue to increase investments to partners who we really think outperformed in various different ways through COVID. And then we'll de-emphasize partners who did not outperform or who did not perform according to expectations over the last 2 years.
If that's on the opportunity side, just in the challenges to those opportunities, interesting thoughts, Thomas. If we look at the macroeconomic environment, the challenge about inflation or dollar or interest rates, or the geopolitical side, the challenge with Russia, and maybe an increased perception of geopolitical risk. Can you talk to me a little bit about how that macroeconomic and geopolitical situation has been impacting on your business?
Sure. No, I think it speaks to, again, the necessity of a scale platform, an asset manager who has managed through multiple cycles, who has the capital structure flexibility, and the expertise, the scale and the expertise, marketing expertise, technical expertise, partnerships with OEMs, and through multiple cycles, because this stuff pops up all the time. And I think that there were a lot of new entrants into the leasing market over the last 5, 6, 7, 8, 9 years, who entered in a period of relative stability, entered in a period of very low and stable interest rates, into a relative period of global macroeconomic growth, gently upward sloping to the left, without a lot of fuel price volatility. And they thought the business was easy. Or they thought that anybody could come in, 3 guys in a garage with a warehouse could come in and be a successful lessor. And I think this more challenging environment is more the pendulum switching back to really the challenges that we face over the last 30-something years as a platform. And it requires expertise, scale, discipline, capacity, capability, capital. And so I think you will see a return to normal in terms of these challenges flaring up. And then you'll see differentiation in different platforms' ability to perform in greater volatility.
Yeah, and I think we might pick up that scale point in a minute, because it's one we've seen thematically emerge a lot as we've been having the conversations for this year's report. Maybe before we get there, focusing on the debt side and the interest rate environment that you referenced, I think having this conversation a year ago would have said rates are going to go up. And I guess someone said they were going to be 4% or so at this time. Maybe people went, that seems a little bit high. But I guess it happened so quickly and in such a condensed fashion. There's a little bit of whiplash in the market that seems to be causing some challenges. Can you talk to us about how you've seen those challenges develop? I'm just interested on your thoughts over how that heightened rate environment is feeding in on lease rate factors.
Sure. So several things there. One, there's, in terms of higher rates for financial services companies that earn their money on a spread basis, net interest margin, higher rates are in many ways a good thing, fundamentally a good thing. The volatility around rates, I think, is what creates problems and created so much consternation over the last 6 to 9 months. So a structurally higher rate complex for an investment grade lessor who funds at the corporate level, that creates competitive advantages for us. So we're not afraid of higher rates. Volatility creates problems, but structurally higher rates necessarily do not. In terms of how that flows through to lease rate factors, one, obviously the input cost should raise lease rate factors, and we're seeing that now. Ours is a long cycle business in the sense that contracts get written, campaigns are fought, aircraft are ordered months and years in advance of when they actually hit the P&L or when the aircraft actually delivers. And so there's a natural lag of that. And some people will tell me it's 9 months, some people will tell me it's 12 months, some will say 18 months. we'll see. I mean, you're already starting to see move the needle up. When you look back at the calendar and you see when rate volatility really started to kick up and rates really started to exceed, it was spring, summer of last year. So that 9 to 12 to 18 month rule would suggest that, again, we're already seeing upward trajectory in lease rate factors. You'll continue to see that into the spring and summer, assuming the interest rate complex remains high. And so we would expect lease rate factors to continue to increase into the spring and summer to a place where people can make money. Because you can only put so much dumb capital to work. You can only lose so much money before discipline forces you to re-rate your business. And we expect the industry to see that.
Yeah, it seems logical, as you say, that overhang of capital just has to expire, right? And it is really a question of just economically when. To your point on investment grade lessors like yourselves, you have that ability to tap the capital markets and did so very effectively. Like most IG rated lessors, you know, sensibly raised funds in the lower rate environment. If you're not an IG rated lessor, what options are available to you out there now?
Yeah, I think it's going to become a big challenge, and this is so. It's important. You know, scale is a very generic term in our industry, and a lot of people equate it just with number of aircraft owned, managed, and leased. To me, scale means a very different thing. It's much more nuanced and detailed. Scale means ability to finance yourself on an unsecured basis, ability to finance yourself at a corporate level, investment grade ratings, a global marketing team, a global technical team. Relationships with key lending banks, you know, all of that stuff to me is scale. And so I think that lessors with scale in the sense, you know, ability to finance in the term loan market, ability to finance in the capital markets, ability to find other pockets of capital when there are mispricings in the bond market, that is going to be a competitive differentiator on the go forward. I firmly believe, and I think you're already starting to see it. Lessors that rely on captive warehouses, lessors that have to fund at the asset level, lessors that have to term out existing funding facilities into a higher interest rate environment. I think a lot of those players will struggle. Either the capital will become less flexible, which is a huge disadvantage, or the capital will become less visible in the sense that you only have a certain period of time, you're going to have to term it out, and you don't know what the cost of that money is over the length of the lease. You can only see 12, 18, 36 months out at lower LTVs and so on and so forth. So I think it's going to be when spreads were low, money was cheap, it was easy for people to make business decisions based on fleeting costs of capital. Now it's a lot harder, and I think you'll see that next year.
And that would imply kind of two things, really, as you chat that through, Thomas. One, probably a little bit more distress, right? Potentially within the aviation finance world. And second, by extension, more consolidation. Would you agree with that kind of hypothesis if you're saying, you know, the debt side will become more challenged? You know, people who haven't had a sensible strategy and how they're funded versus the assets that, you know, are income generating. Would that be kind of where you'd expect the market to go in the medium term?
So yes, the answer is yes. You know, I always get a little squeamish around the consolidation word. To me, it's just a transfer of ownership of assets. You know, I've seen these charts. There were 95 leasing businesses 10 years ago. There were 105 5 years ago. There's 97 now. You know, so there are transitions of ownerships. There are merging and consolidations of platforms, but the overall number of players or amount of capital in the space, I think you'll see remain relatively stable, at least over the shorter to medium term. But I do think that you will see transfers of ownership. So yes, so if the ABS market stays closed, if warehouses term out, and there's not an ability to refinance those assets in the ABS market or through other people, then they'll have to dispose of them one way or another. So you could see more distressed sales into the secondary market, which of course we would be natural buyers of. I think hopefully you'll see fewer capital formations in the sense that new businesses starting with new money. So certainly I do think that, again, if in a tougher environment where capital is harder to come by, it's less flexible, and it's a harder operating environment, easier to lose money, so on and so forth, hopefully you'll see a lot of assets transition from platforms that aren't really capable of owning aircraft through challenging cycles, moving from them to platforms that can operate and can access capital through more challenging cycles.
Yeah, and just one more thought around that. Presumably, as you say, that scale point, and I take it not being size, I take it being, as you say, having the relationships, the access to liquidity along lots of different avenues is becoming, increasingly important in this more constrained environment. That would seem to imply that your barriers to entry get that little bit higher. And I'm presuming then that you would also, I won't presume anything. Do you agree that that might just increase your barrier for new entrants as well, and that we're unlikely to see it probably as many new entrants as we've seen over the last few years?
I would hope so, Joe. We joke a lot about it. In a global industry as capital intensive as we are, the barriers to entry have been surprisingly low, and the barriers to exit have been surprisingly high. There are a lot of zombie portfolios kind of limping around that I would have expected to disappear a while ago, but they find a way to hang on for one reason or another. So I think you're right. But again, the aviation investing complex has become an industry in and of itself. Aviation investing used to be one or two chairs in a larger structured finance desk, or hard asset trading. It'd be one chair on a hard asset trading desk or something like that. The aviation investing complex now are entire companies, teams of people dedicated to each slice of the capital structure. So it's deeper, it's more sophisticated, it's more pervasive than it's ever been, which is a great thing. But to me, it's also trained me never to believe that capital will leave the space as quickly as I think it might. Just transitions to a different place or a different part of the capital structure. But I hope you're right. I hope you're right. We could use a more orderly market for sure for a period of time.
Yeah, and that point you made about the kind of, I suppose, the coverage of the sector, right? There's always been a low number of listed lessors, but the increasing number of IG rated ones, and I suppose the maturing and attractiveness of the sector from an investor perspective. On that front, Thomas, can I get your thoughts? Have we seen any evolution of the types of investors that have come to the space? You guys were formerly owned by an insurance group. You were owned by Japanese Capital now, which is a long and storied history with aviation. Have you seen any themes on the investor side that have emerged post-COVID?
No, clearly, it depends on what time period you're talking about, but clearly over the last 15 years, we've certainly seen the institutionalization of aircraft leasing and the globalization of aircraft leasing to a degree. It was always an institutional global business in the sense that the Europeans owned the big leasing platforms, and it was primarily leasing businesses were used to fund long duration liabilities, so insurance companies and things like that. Then the assets moved to the expertise where the industry, the center of gravity moved to the Americas for a little bit, moved to Asia, then moved back to Europe. Now, we'll see where that ends up. But in terms of big, sophisticated, well-capitalized, institutional, competitive players, it feels like the industry has grown up a ton in the last 10 years. And a lot of that is just excess liquidity. You've seen it in other asset classes and in other sectors. There's so much money sloshing around looking for excess return in a low rate environment. And aviation has proved to be a great place to put your money. Long duration, US dollar, secured by the assets that move, well-managed platforms. It's been a good business, but the amount of capital that rushed into the space over the last 10 years has certainly changed the landscape a lot. Some for the better, some for the worse. But it's a much more institutional business than it was even 10 years ago, I would say.
And on that comparison with other asset classes, as you say, as we move into a more capital constrained global environment, What are your thoughts on aviation's attractiveness as an asset class? We talked a lot about the maturing, but there's probably also the element there where one, hit harder than COVID by most, hit harder by the Russian invasion than most. And the counter to that is it's been incredibly resilient. So very interested in your thoughts over when you look at, aviation as an asset class, are we in a better or a worse place than we were 3 years ago?
Well, I would say better from an investing standpoint, because when you talk about 3 years ago, 2019 from an investing standpoint, that was the 9th or 10th year of the upcycle. It was tough, from an investor standpoint. A lot of the excess rents have been competed away in favor of there was so much money trying to get put to work in the same place, new technology, narrow bodies, new assets, high quality credits. It was a very tough environment, in 2019 from an investing standpoint. So here we are 3 years later, we see a lot of opportunity. It's tougher. I think what we'll see now, aviation is still a great place to invest. Leasing is still, the aircraft and leasing are still great, provide great investment opportunities. But I think people have come to see the industry for what it is. I think people forgot how challenging it can be. What's required to invest through the cycle, the expertise required. So I think the amount of capital that flooded into our space, the sophistication of the investors from private equity to others that have come into our space has forced everybody to become more sophisticated and has increased the competitive dynamic in the industry. And so I think everybody has needed to become, to notch up their game, become more sophisticated, become better stewards of capital, better investors. But in terms of opportunities to invest now versus 2019, I think there's more opportunity to get excise rents today than there were in 2019 when we were at the peak of the peakity peak. And people have been, on the investing side, we've been beating each other up for that last dollar at the top of the market.
Yeah, it's a very interesting perspective, as you say, just dislocation meeting opportunity. Back to your point, if you got a good platform and you can raise the right capital, then you can go after that opportunity. Whereas every Joe Soap has that capital, you're fighting with the silliest dollar, right, to try and make a return. One of the challenges the sector clearly is facing and will continue to face is on the ESG side, particular focus on the E. Can I get your perspective on how ESG is impacting your business currently and how you see that developing in the coming years?
Sure. No, so it's critically important for us. It's critically important for our shareholder, Tokyo Century. Tokyo Century actually has a AA rate, an MSCI ESG rating, AA. So it's something we spend a ton of time thinking of. And as everyone would say, it's not just the E, it's the S and the G. A lot of stuff we're working on the S and the G. On the E side, you will see it. It's something our industry needs to focus on. For us, where we choose to spend our time, energy, and our money are on initiatives that are actionable in the near to medium term. And so that's helping airlines get access to and finance new technology equipment, which is something we're capable of doing, we're quite good at, it's our expertise. And then incentivizing, hopefully, lessees, whether it's through lease incentives or other things, to move toward a more environmentally friendly operating model. And then in terms of SAF, which we think is the most actionable, near-term, practical way to help get our industry greener sooner, we're investing our own money, and we're also supporting other people's investments in trying to bring more SAF capacity online in the next, call it 18 to 24 months. So it's we're chipping in, we're doing everything we can. I think it's an industry initiative. Everybody needs to participate. We're a signatory of the ALI initiative that was announced with great fanfare last month in Dublin, as well as other things. So we're super focused on it. We're participating where we can, but it's the entire industry, I think, that needs to get on board and do their part to help move us in the right direction.
Can I probe a little bit on the SAF one, which is clearly the main building block that people see until we see more technological developments on the metal side. It is interesting, and you talk to aviation finance professionals who've done superb work in helping airlines grow, and you do think there's a space here for those to step in and really try and kickstart the SAF piece, which we all know is massive production challenges, needs more technological developments as well. Can you talk to us a little bit about ACG's actions in that space if you're really interested in it?
Sure. No, I mean, look, right now we are being shown actionable investments in SAF projects that we're evaluating, Tokyo Century is evaluating. We're also working on, anchor participation in funds dedicated to investing in SAF projects. So putting our money where our mouth is. We're also, I think we have now, in terms of ferry flight deliveries, we will use SAF fuel. Again, we are not the ultimate operators of our aircraft investments, but in places where we do have decisions over how to fly those aircraft in terms of fuel and other means. We're doing ferry flights with SAF fuel already, and we're trying to encourage our lessees to leg it SAF more progressively over time. So it's on the operational level in a small way, and I think in 2023 you'll see from a capital perspective in a bigger way that we will try to speed along the proliferation, the accessibility of SAF for our airline customers.
Yeah, look, I think it clearly does. It needs that support, clearly, right?
Yeah, with direct investments, we're prepared to invest in projects to help speed it along.
Yeah, no, I think it's going to be very interesting as we have this chat next year and the year after and the year after, just to see how the developments have gone.
The urgency is here. The need for action is immediate. But it's a long cycle business. These are solutions that take a long period of time to design, map out, implement, and then have come online. And so the frustration will be feeling that sense of urgency, but understanding that some of this stuff just takes a little bit of time to flow through the system.
Shifting gears a little bit, Thomas, just on the fleet focus and really interested in your thoughts around investable metal. You mentioned, everyone was chasing narrow body new tech earlier, and I guess if you gave people an option at the right price, that's what they go into. But wider than that, you mentioned the dislocation in the market, kind of opportunities from a metal perspective. And in addition to that, getting your thoughts on the wide body market, which seems to have had some positive recent developments.
Yeah, so we do think that, again, the pendulum always swings too far. And we would say, in the middle part of the last upcycle, people were very excited about wide body investments, and which I get. In good times, they generate higher lease rate factors, they throw off a ton of cash, they contribute meaningfully to earnings, but obviously higher risk, which I think a lot of people lived through the last few years. Again, we're a core narrow body shop, so we always try and stay light. Through COVID, we do finance medium new technology wide bodies in the finance, so we will help owners of medium wide body new technology aircraft finance the purchase, where they put equity in the bottom part of your capital structure, they bear the residual value risk, and we eliminate the risk of transition in most instances. So we've been participating more in the wide body space on that financing side. I do think, again, the pendulum has swung too far, it would feel, the other way in terms of everybody's risk off the wide body space, whereas I do think that, the core 789 platform, the A350-900, those are very nice platforms and can serve a strategic role for airlines in certain capacities that we would find very compelling. So I do think that ACG will take a harder look at the right medium wide new technology wide body investments to the right carrier who are using them strategically in places we think make sense. But we're always going to be a core narrow body shop. So you'll see us make those investments at the margin, opportunistically, strategically, but I don't think you'll see a wholesale change you won't see a wholesale change in our strategy.
And can I get your thoughts then on the trading environment in two aspects? There would be some feeling in having these conversations report that trading market's not entirely functional. I come on to the OEMs properly in a second, but we've had delays. Big players like yourselves probably haven't divested the way you might normally do. So that's one aspect. And the second is just around values, where you are in an inflationary environment, but the interest rate environment is probably putting a pull on values. So can I get your thoughts on one, just the state of the trading market and how you see that evolving? And two, what's your take on kind of how asset values are moving?
Sure. Yeah, so the trading market is anemic now. There are some portfolios in the market or bespoke opportunities in the market right now where certain players are just trying to accomplish some year-end objectives or trying to reshape things moderately. But again, those are not thick, meaty trading opportunities. I wouldn't be the first one to say that this fall, there was just a fundamental disconnect, between people looking to trade out of metal, particularly investments that had been made in a low rate environment, where the entry multiple, when you think about the rate going in, DCFs work best when the exit multiple is higher than the entry multiple. And of course, with the higher rate environment, we have not seen that reset in pricing expectations. And so, some of it's seasonal. It's the end of the year. There's been no big chunky opportunity or no need per se to reset expectations in that market, but it's coming. I do think that when the year starts, you will see a bunch of RFPs come out or big portfolios come out, test the market, and something will need to give. Either people will have the ability to wait for a little bit longer, but not too much longer. And then if the rates are still high, then pricing expectations will need to come down, particularly on older metal financed in a lower lease rate environment and a lower rate environment. The market clearing price for that is meaningfully different than it was in a lower rate, lower lease rate factor environment and lower risk environment. And the number of alternatives, whether it's the ABS market or something else, are shrinking. And so at some point, people will need to trade, and they'll need to take the market price at that time. So you can see opportunities for buyers. I think it will become more of a buyer's market than a seller's market, assuming rates stay where they are today, relative.
Yeah, I think it's going to be an interesting one to kind of watch and develop, as you say, early part of next year. Shifting gear again slightly on the OEM side, part of the challenge we've seen on the trading environment has been the delays. And can I get your thoughts on the OEMs? One, as a lessor who has had an order book, and I think still has an order book, if I'm not mistaken, right? Has the pandemic developed or evolved relationships between the OEMs and lessors?
Yes, it's look, you learn a lot about relationships under high pressure, tough times. I would say we have very good relationships with our OEM partners now. We went through the peaks and the valleys together. I would say, for the most part, there were some tough conversations, but relationships are founded on doing what you need to do for your partners when you have to. And I would say on both sides of the equation, when either side really needed it, whether it be ACG or OEM partners, we found a way forward in a really tough time. So I would just say we learned a lot, and some of it was a little bit challenging, but some of it was also very good and reassuring in a tough time. Our OEM, the manufacturers have a lot of challenges. So they're, in many ways, they have a lot of stuff they need to work through and figure out. And they're getting hit by the same exogenous shocks and supply chain pressures, geopolitical challenges that we are. And so in many ways, they're going to need to grind it out. We're going to need to grind it out with them. But delays are frustrating, and they really do throw us off, and they mess our plans and kind of create a lot of headaches for us. but also, they are creating inadvertently, they're creating supply constraints that we benefit from in other ways. And so as new technology deliveries get pushed out to the left, it's making our current technology release rates come up. And it's giving a lot of our existing portfolio, it's giving us more opportunities to see those last in the market a lot longer than maybe we would have believed a number of years ago. So with challenges become opportunities, honestly. And I think we're seeing that on the OEM side for sure.
And another opportunity that we've kind of seen in the market develop, probably a segment of the market that's probably maybe performed as strong as anything since the outset of COVID, is around cargo. Can I get your thoughts? Is that a space you guys have played in? It's always been a spiky market. We've seen a step change post-COVID. Question mark about how sustainable that is, and maybe too many players potentially going into that space. So just interested, is an area that ACG has moved into, or is it one you see opportunity in?
So we are not big freight players. I would say, in the fever to, the narrow body conversion trend that you saw over the last number of years, there are a lot of people who are expert in that space. There are a lot of people who commit capital to that space. That's not an area that we want to be expert in or focus in. And so the way we played that bid was to sell metal to the conversion specialists, the cargo investors, the people who specifically wanted to commit capital to that space. That we decided years ago, that's not somewhere we wanted to be an expert, and that's not somewhere we wanted to tie up our capital. So we've sold that, and there's been a very strong bid. People who had invested in slots, committed to slots, and then couldn't find the airframe to put into that slot. So we actually sold into that strength over the last number of years, and we're pretty pleased with that. We do not have significant cargo exposure. We do not want to have significant cargo exposure. If you look at the volatility in that space, the volatility within a volatile sector to us just seems very risky and not somewhere we want to spend a lot of time. I'm not an expert in that space, but I think you're already seeing, and it's separate and aside from the package delivery, the dedicated carriage, the parcel delivery stuff. That's cargo, but not really cargo. When you look at classic air cargo, it just feels that market could come under significant pressure over the near to medium term. And I actually just read today that Maersk, who has a more informed view of cargo than any other player in the world, just swapped out their CEO, which to me suggests that there are some rough seas ahead in the cargo market.
Yeah, it's been interesting, and having again discussion. Lots of different views, I would say, right? And we chatted to a few of the main cargo providers, and it is a space, and I can get you the ACG approach, and you, like any space, you need to know what you're doing, right? But as belly capacity comes back, as we wonder, the amount of conversion was undertaken, just how these things feed in, and a little bit of the other pieces. I think it's one that we will come back to, I think, in the future to see how that evolution has gone. Thomas, lots of interesting insights as always, and opportunity is a theme of what we chatted through on a lot of these different points. And standing back, as we're here in December, looking out into next year with that opportunity in mind, but some of those challenges also that we've spoken about. What are your optimism levels like?
Yeah, so I'll think this time last year we were pretty darn optimistic, actually. Last year we really started to see October get better than September, November get better, December get better. We felt pretty good coming out of January. We felt pretty good going into March, honestly. And then we as an industry got punched in the nose pretty hard by Russia's invasion of Ukraine, obviously. And so really, I would say fundamentally, there are a lot of very constructive things about 2022 that you just don't see because the headline noise is just so great. I would say we feel I feel personally very optimistic about 2023 right now. We've done a ton to improve our portfolio, our platform, where we got money to grow, we've got capability, we've got access to capital. So I think you'll see ACG really, I've said in other forum, I think we are already in the second or third year of the next upcycle. It just doesn't feel like that. Usually it's not until the middle of the cycle that you realize, oh, we're in the middle of the cycle. So I think that we are now entering 2023 looking to the stuff we do now, the stuff we do today, the stuff we do next year is going to determine the type of cycle we have, in the sense that the investments we make now is what you will see hit our P&L in 24, 25, and 26. And so now's the time for us. We haven't grown in 3 years. We've gone sideways for 3 years. And so now's the time for us to grow. Now's the time for us to show that differentiation, that competitive differentiation in our space, and really to take advantage of the hard work we've done over the last 2 years to position our portfolio for now. So pretty excited about it.
Well, Thomas, great to hear that ambition. I would hope it all comes true for you and ACG. And on behalf of KPMG and Aaron Lars, I'd like to thank you as always for your insights today and wish you a great 23.
Thank you so much, Joe. Pleasure spending time.